New investors are making this mistake and it's costing them thousands of dollars. What's up everyone, Jordan here, and today I want to do another basics in finance video because I think this is a very important investing technique where I think a lot of new investors they don't know about, and it will cost them tons and tons of money in their investing career over the long term. So as this video does talk about finance, I do want to disclaim that I am not a professional financial advisor. So I am just a guy in my basement filming these videos for entertainment purposes. And so before you guys make any kind of financial decisions on your own, make sure you do your own diligence on your own research and maybe consult a professional financial advisor yourself just so you could get the best information possible before spending your real money on investments. So what I'm talking about is dollar cost averaging, or DCA. Basically what dollar cost averaging is where you spend your principal or whatever your starting money is, maybe it's like $10,000, and you spend that on a target asset. Say I want to buy like Tesla stock. So I purchased Tesla stock and I spend a little bit of my money at one period, and then maybe like 2 weeks from now I buy it again, and so forth. So I spend a little bit of my money each time over a long period of time, and the idea of this is so that I could reduce the volatility of the asset price, because stocks, cryptocurrency, they're all volatile assets and we don't know what the price will be in the future. And so to reduce that volatility, you spend your money over the long periods of time, and then on average you're going to spend less than if you had spent your entire principal in one sitting. So of course there's going to be rare cases where if you just buy the asset and spend all your money in one sitting, it's going to be cheaper in the long run. But it's been proven by a lot of investors, and if you do like simulations, it just mathematically it's a lot better to do dollar cost averaging than lump sum spending. So I'm going to show you on the computer real quick, just like a really quick simulation, just so you can see how the math works out and how you can save a lot of money by doing dollar cost averaging in your investing. I just want to do a quick plug-in on the apps that I use for investing. So if you guys want to get into stocks and start trading stocks, I would highly recommend Questrade. I believe it's only for Canadians, but I'm not too sure because I have some international friends that also use Questrade. But Questrade is a really reliable stock broker, and if you use my referral link down below, you'll get $50 worth of commission-free trading, because each trade you make on stocks will cost you $5 commission, so that's essentially 10 free trades. If you guys want to start getting into cryptocurrencies, which I'm personally investing heavily in crypto, then I'll have the link down below for crypto.com. Crypto.com is a very newbie friendly interface. The user interface is really easy to use and easy to get through and used to. You can buy, sell, and transfer cryptocurrencies super easily on the app. So I would highly recommend crypto.com. Alright, so I just wanted to do like a little simulation on, we can see if dollar cost averaging is better than the flat sum. Of course, this is going to be a really small simulation, so of course, I actually don't even know what the numbers are going to show up as, but I have faith in dollar cost averaging working out well. So the setup that we have is that we have a $10,000 principal, and actually we want to buy Tesla stock. So Tesla, of course, is a really popular stock at the moment, very infamous on Wall Street bets, and yeah, also very volatile as well. So say we have $10,000, we want to buy Tesla. So we have on the chart here, basically just the Tesla stock in the history. I'm not going to pull numbers from recently, because recently Tesla had a huge pump here, and so the numbers are going to be kind of skewed, and because we have backward information, if we cherry pick these, then like, yeah, it's going to be kind of unfair for our calculation. So I'm going to pick kind of an area that's kind of more consolidating period, because I feel like consolidation period is just like a good time where you can really see how dollar cost averaging can shine. Maybe it's cherry picking still, I'm not too sure. Like I said, I haven't plugged in these numbers, so I'm not sure how it's going to turn out. But say like you're around August, September time, right? And you're like, okay, you're monitoring Tesla, and you're like, wow, Tesla made this huge pump here. Maybe Tesla is going to keep going up. You're not sure, because obviously we don't know the future at that time. So you still wait a bit. It starts going down. It makes this big deep. It makes kind of like a small dump here, and it starts going up again. So to make this easy, say like you're getting your paycheck, so you get paid twice a month. So you want to make so for the dollar cost averaging side, we're going to be making two purchases of Tesla stock per month to coincide with your paycheck. So let's start like with our comparison. Let's say September 15th. Sure, that's like a pretty good number. Pretty good date to start off with. So the price of Tesla at the time was $449.76. So say if the price at the time of September 15 was $449.76, and if we're comparing it to the flat sum, so if you had spent your entire $10,000 at this price, you would be able to get how many stocks? 22 stocks, because you can't get partial numbers of stocks, so you'd be able to get 22 stocks at $449.76. So pretty simple math for a flat sum. That's all it is. Now for dollar cost averaging, say every 2 weeks you want to purchase $2,500 worth of Tesla stock. So we could do that 4 times with our $10,000 principal. So this is going to be over 2 months. And so the first time you purchase it at $449.76, and that's going to give you this amount of stocks, 5 stocks. We have to round down here, but we'll fix the numbers afterwards. Let's get the prices of Tesla first. So if we go up to September 30th now, it's now $429.01. Next off is going to be October 15th. Let's see the price of that. So the price on October 15th is $448.88. Plug that in. And finally, at the end of October, on October 30th, it dropped down to $388.04. So we can see how many stocks we were able to purchase by summing up all of these. I'm going to have to reduce these decimals because all of these are rounded down, since we can't purchase partial stocks at the time. So each time I'm only able to buy 5 stocks, 5 stocks, 5 stocks, and 7 stocks. And this is also 22. This rounds down. So actually, over the 2 months, we were able to purchase the same number of stocks as if we were going to purchase it at the flat sum rate. However, let's check out the average price of the stock that we purchased it for. So if you average this out, we actually only paid $416.42 for 22 stocks of Tesla, whereas if we had done the flat sum, we had paid $449.76 of Tesla. So as you can see, the difference there, we saved about $33. And of course, because we had to round down, as you guys saw earlier, we actually had high decimal points, like over 0.5, which typically rounds up because of course stocks you can only round down, which means that we still have some extra cash in our cash account afterwards. So that means we still have some leftover cash, and on average we paid less per stock of Tesla than what we did if we had done the flat sum. So of course, while we still have the same number of stocks, we did save some money. And like I said, this is something that's going to affect you over the long term in investing. So it might not seem like it made much of a difference in this example. However, if you keep doing this dollar cost averaging on all your stocks and you keep investing more and more money in, it's going to really add up. Like we saved $30 here. So say we did that 10 times, that's $300 that we had saved. And yeah, all of that, like I said, just like the previous video as well, if compound interest, we saved $30 here where we could invest for other things, or we could reinvest later on. And you know how compound interest works. Now if you haven't, go check out the video. I'll leave a card up on the top so you can go check that out. Compound interest really stacks up, and yeah, that's why I think dollar cost averaging is just a really good technique to be using when you're investing, especially if you're investing for the long term. And I highly recommend everyone do it. Not financial advice though. Like if you do like some technical analysis, some market analysis, and you really think that the price of the stock at that current time is undervalued, and you think that the price of that stock will only go up, then yeah, you could just do lump sum or flat sum spending and purchase all the stocks now. But no one can see the future. Like your Tesla stock might be at $449 today, but it might just drop down to like $200 the next day. We never know. So yeah, if you guys, I hope you guys learned something from this video. If you did, make sure you give the video a thumbs up and subscribe for more financial videos like these. And yeah, thanks everyone for watching. I'll see everyone next time. Peace.